Fred Pacelli here, CPA based out of South Florida. So in my last video, what we talked about was the importance of tax planning and getting it done before year end. So basically right now we are in the prime tax planning period. We have 3 months left of the year. So what I want to cover today is the 5 simple but major things you can do just to make sure you're taking advantage of any tax strategies that might be out there for you. So the first one is take advantage of your company's retirement accounts. If you have not yet, at a minimum, try and take advantage of at least the 401k match. It's normally a percentage of what you contribute. And then also try and put away as much as possible into your company's retirement accounts or even your own retirement accounts. Those are all current year tax deductions, and they're going to be taxed. The growth on those are going to be tax deferred until retirement. So you get to save money in this year, and then later in future years, you will pay the taxes on that. Those are called pre-tax retirement accounts. The other type you can take advantage of are after-tax retirement accounts, such as Roth IRAs. So number 1, make sure you're taking advantage of your retirement accounts. Number 2, if you're eligible, make sure you are going to take advantage of health savings accounts or flex savings accounts. So health savings accounts are basically going to be accounts related to health expenditures that you're going to contribute cash to. The limit is a bit smaller than the 401k or the 457 or 403b. It's around $4,000 for the year of 2025. What you're going to do is you're going to contribute cash for future medical related expenses. That's for the HSA. It's also pre-tax and post-tax deductions. Now, the FSA is a little different. That's going to be a lot of a smaller amount. It's normally going to be employer sponsored, but this is something that you can basically use and contribute a set amount per paycheck to basically spend on medical expenses you're going to need in the current year. So example would be if you know you're going to need contacts or you have certain prescriptions that you have to pay for monthly, an FSA would be worth maximizing right now if you have to, in the last 3 months, to take advantage of some of that. So the third one is going to basically check that your dependents and withholdings on your W-4 are accurate. Now, this is actually something you probably want to do in the beginning of the year, but it still might make sense to check right now. See if you want to update those. Make sure your federal, state taxes, whatever it might be, is being withheld correctly. Basically, that you would go to your HR department at your job or see if there's some sort of portal you can log into, access your W-4, make the adjustments, try and calculate what should be getting withheld. And so at year end, there's no surprises. You didn't pay enough taxes or you paid way too much. So the fourth one is something called tax loss harvesting. Normally that's going to be done when you have some equity investments, stock investments, and they're at a pretty big loss or at least a small loss at year end, and you don't think they're going to recover. So normally what you would do is at year end, you would recognize that loss. So you would sell those equities, and then that would help offset other capital income, or there is a deduction of $3,000 maximum per year that you get to use on your individual return. The fifth one is going to be basically related to 1099 contractors or business owners. Just make sure all your business expenses are being recorded, they're being categorized, you have them on hand, maybe like something in QuickBooks or Xero, or at least at a minimum, an Excel sheet. You don't want to miss any simple deductions because every deduction missed is more money you're paying in taxes. Now, an extra one I'm just going to throw in here is going to be if you purchased a house this year or even last year, be aware of what your mortgage interest is and the real estate taxes you paid are. So that those are going to be issued on a 1098 you're going to get from your lender. Basically, that's going to show how much in mortgage interest and real estate taxes you paid for the year. So if that's above $15,000 if you're single, or $30,000 if you're married filed jointly, there's a strong chance you're going to be able to itemize this year, especially with interest rates being as high as they've been the last few years. So definitely take a look at that, see if you're eligible to itemize, and then that opens up a whole door of other things that you might be able to save money on with taxes, such as charitable contributions, medical expenditures, and even some tuition-related expenses. So those are the 5 main simple tax strategies you can use for year-end tax planning, and then also see if you're eligible to itemize. All right, thank you.